If you're shopping for a mortgage and you're comparing fee sheets, worksheets, emails, text messages, or verbal quotes from different lenders to try and find the best deal, you might be comparing completely different loans. And that's exactly why the government created something called the loan estimate. Today, I'm going to show you why the loan estimate is the only document you should use when comparing offers from multiple lenders. And I'm even going to walk you through a side-by-side comparison to show you how to read them and what to be on the lookout for in case you run into any shady actor. So make sure to save this video and share it with people you care about when they buy a house or try to get a refinance, because being able to read a loan estimate could save you tens of thousands of dollars. Let's take a look. Let's say you're buying a $400,000 home. You talk to 3 different lenders. Lender A says your rate is 6.25%, lender B says 6.125%, and lender C says 6%. Obviously C wins, right? Maybe, but maybe not, because a mortgage rate by itself tells you almost nothing. What if this 6% loan requires you to pay $8,000 in discount points? What if one lender is going to charge you for origination, but another is baking that fee into a higher rate? What if one lender has mortgage insurance that's $25 more per month? This is why mortgage shopping can be so confusing. There's just so many moving parts, and it can seem like everybody is speaking a different language. Enter the loan estimate. The loan estimate, often called an LE, is a standardized document used to give you, as the borrower, an estimated quote of what the loan is going to cost you. It's an estimate, meaning the final numbers can change, but there are legal restrictions on what is allowed to change and by how much between the original loan estimate and the final numbers that you see at the closing table. Every lender is required to use the same format of loan estimate. It's the same boxes, the same calculations, the same disclosures, the same sections. In other words, it forces lenders to present information in a consistent way so consumers can make meaningful comparisons between one loan or one lender and another. Think of it like nutrition labels on food. Before nutrition labels, companies could market products however they wanted and put whatever they wanted into their food products. But now everything is presented in a standardized format for a nutrition label in the United States. So as of 2015, loan estimates do the same thing for mortgages in our country. That's when we went from basically the Wild West, a world where lenders could just present fee sheets and call it a day, to one where legal standards are enforced by uniform rules put in place by the federal government, all to protect you, the borrower. Now, let me be really clear about this. Fee sheets aren't inherently bad or dishonest. I use fee sheets all the time to give people rough scenarios, usually at the very beginning of our conversation. Someone comes to me and wants some ballpark numbers on what a monthly payment might be if they buy a home at a hypothetical purchase price with a hypothetical credit score. Now, at this point, the person hasn't given me concrete details about themselves, so I can't give them any concrete details about a loan. But I can give a best guess based on partial info, which is what I use a fee sheet for. The problem can be that fee sheets are not regulated. Lender A could include every fee, lender B could leave out half of them, and lender C could exclude discount points, and suddenly everyone looks cheaper than everyone else. That's why whenever someone tells me they're shopping, I always say, perfect. Go get loan estimates from every lender you're talking to, and then let's sit down and compare all of them side by side. Because now we're looking at the same document with the same rules. Quick caveat on this point. If you're shopping rates with different lenders, you really want to compare loan estimates. Otherwise, there's no guarantee what you're seeing is going to be what the lender actually offers you. But in order to get a loan estimate from a lender, you will usually need to fill out an application and give them some of your documentation, things like pay stubs, bank statements, W-2s, and they will probably want to pull your credit. Now, some people get nervous about this. They don't want multiple lenders pulling their credit because they think each one will have a negative impact on their credit score. But there's some good news here. As a part of encouraging consumers to shop for the best mortgage interest rates and loan fees, the CFPB, the Consumer Financial Protection Bureau, made it so multiple mortgage lenders can pull your credit within a 45-day window without it impacting your score negatively more than once. So you can have 10 different lenders run your credit within the same week and you'll only have one hit to your credit, and that's usually very minor. Just a couple points. Now this only applies to mortgage loans, so just keep that in mind. So now you've got a loan estimate or two. Where do you start? Most people probably jump straight up to the rate. Now rate matters, but it's not actually the most important thing to start with. You actually want to start up in the top right corner. If you're wanting to compare apples to apples, loan term, product, and loan type are key. You want to make sure these match if you're really rate shopping. Now these can be different if you're looking at different strategies, but for most situations when you're shopping loans, you want to see the same values up here. Quick tip while we're up in this right corner. If you're shopping rates before you're under contract in a home, then the rate lock section will almost always say no. In general, you can't lock your rate until you have a specific property to tie the loan to. There are some exceptions to this, like if you're working with a builder or if you're using some sort of lock and shop program, but just keep in mind that if you're doing that, you're almost certainly getting a higher interest rate. But if you're shopping loans after you're under contract, you may have one lender with a locked rate and one with an unlocked or a floated rate. So just keep in mind that the unlocked rate could change at any time. So now that you've made sure the loan structure matches, you want to look at the terms: loan amount, interest rate, monthly principal, and interest. This should be the first place where you start to see differences between lenders, unless they're offering the exact same rate. Below that, you'll see the projected payments. Now, you'll want to pause here. This is where you'll do your first real comparison between lenders. Specifically, you're going to compare interest rates and monthly principal and interest and mortgage insurance if it's present. That's it. Why are we not comparing the estimated escrow numbers? Because it's an estimate, and it isn't the lender that will change those fees. It's the county, city, HOA, and insurance companies. So it doesn't make sense to even look at that escrow number if you're just comparing the loan offers at this point. So unless you just happen to get loan estimates from two lenders offering the exact same rate and the exact same mortgage insurance, you should start to see daylight between the offers right here. Now we're going to skip the costs at closing section on page 1. We will look at closing costs later, but not just yet. So next we'll go to loan costs at the top of page 2 and start with box A, origination charges. This box right here is where you can see what the lender is actually going to charge you for the service of writing or originating this loan. The investors themselves, the people with the money who are fronting it to you so you can buy this house, are going to make their money back from the interest rate. But there are other people like me, the originator, the underwriters, funders, processors, etc., that all have to be paid for the actual work of writing this loan. This box shows what you're paying for the loan. And it will also show you if you're paying to buy points, if you're spending money to buy a better interest rate. There are a lot of ways this box can be structured, but here are the basics of it. If you are charged anything at all for your interest rate, you'll see it here listed as points or parentheses percent of loan amount. If there is a separate underwriting fee, you will see that here. This is really common in the broker world, since the underwriters typically work for the lender, not the brokerage. And most brokers will pass the underwriting fee onto you as the borrower. That's something that I commonly do in my business. If there is an origination fee, you will see it here. This is really, really important. The origination fee, or what can also be called numerous other terms such as broker fee, processing fee, is the amount you are paying the person originating your loan, the loan officer, if you will. That's, again, the role that I serve. You may also frequently see something like origination fee, lender paid, parentheses, percent of the loan amount. What this means is that the person writing the loan opted to go with the lender's standard compensation amount usually in exchange for you as the borrower getting a slightly higher interest rate. What you really want to do in this section is look at the total you're paying for A out of pocket. That's the actual dollar amount this loan is costing you up front as opposed to the interest paid over time. This dollar amount and the interest rate are the two main things you'll compare when you shop loans. Almost everything else on the loan estimate is actually out of the lender's control. Sections C, E, F, and G are all controlled by other parties, not the lender. And the lender has some leeway in these sections when it comes to the loan estimate. They're really just providing an educated guess on these numbers when it comes to the loan estimate. So the final numbers can be different. But for sections A and B, these are the fees the lender controls, and they are allowed very little, if any, lenience here between what they show you on the loan estimate and what they present to you at the closing table and what you actually pay. One pro tip when you're reviewing a loan estimate: if section A looks surprisingly low or even shows no lender fees at all, don't automatically assume you're getting a better deal. Ask questions. Lenders and loan originators have to get paid somehow, but that compensation can show up in different ways. Sometimes you'll see it directly in section A as fees with names like origination fee, underwriting fee, processing fee, administrative fee, or even discount points. Other times, there may be very little in section A because the originator is being compensated through the interest rate instead. Now, neither approach is automatically better or worse. Paying fees up front may help you secure a lower interest rate. Accepting a slightly higher interest rate may reduce your upfront fees. Depending on your goals and your financial situation, either option could make sense. The important thing is understanding what's actually happening when it comes to this loan estimate. If someone tells you they're charging no lender fees, ask them, how are you being compensated? Is this the lowest rate I qualify for? What would my rate look like if I paid fees instead? A good loan officer should be able to answer those questions clearly with no hesitance and show you the trade-offs of either approach. Now remember, the goal isn't to find the loan estimate with the fewest fees. The goal is to find the loan that gives you the best overall combination of rate and cost and payment for your specific situation. So now that we've looked closely at box A, let's move to box B. B, which is services you cannot shop for, is where the lender is doing a direct pass-through of some of their costs. These are the actual costs the lender is paying for some essential pieces of writing the loan. These are things like the appraisal fee, credit report, tax service fee, which makes sure your property tax gets paid on time, flood certificates to prove whether the property's in a flood zone, and sometimes a couple other items can show up here as well. These are items that you as the borrower are not allowed to source yourself. You can't shop for them. You are going to be stuck with the service or provider that the lender picks, and you're going to pay the number showed in box B if you end up going with this lender. Now, the lender is under legal requirements as far as what they charge for those fees, so you're protected that way. But the costs in box B are usually not outrageous. Generally, the appraisal is the most expensive item, clocking in at an average of $600 to $800. And the appraisal is one place where you may actually see a significant change from the loan estimate to the closing disclosure, which is where your final numbers show up. The originator and lender won't know this until you actually find a home and go under contract, but it is possible to get an appraisal waiver. When that happens, the lender is basically saying, based on the loan amount, purchase price, and other data that we have about this property, we do not need an independent third-party appraisal to confirm the property's value. It's rare, especially in certain markets in the US, but it can happen, and it means you're going to keep $500 or so in your pocket. Now, before we continue, I want to do a quick recap on what we just went over. Aside from the interest rate, box A and B on page 2 of the loan estimate are what you want to look at when comparing one lender to another. This is where the cost of the loan shows up. Just because one lender has a lower rate does not mean they're offering the best deal. It can often mean that you, not the lender, are subsidizing the lower interest rate. Almost everything else on the loan estimate is essentially pointless when it comes to shopping loan offers from different lenders. It's all costs you're going to pay no matter what lender you choose or title company you choose, and the numbers are going to vary a bit, and they're going to be largely out of your control. The one exception, box J. You always want to check box J to see if there are any lender credits being offered. If you get a loan estimate that has the same or better rate as other lenders, similar or lower fees in box A and B, and there's a lender credit offered in box J, while the other lenders didn't offer a credit, that's basically a slam dunk. You can have a high degree of confidence that you're getting a great deal by going with that lender. Now, I'm not going to dive into all the remaining sections on the LE in this video, but I will cover them at a high level. First, section C, services you can shop for, is basically your title or settlement fees. The title or settlement agent and service are essentially a third party responsible for managing the transaction. They ensure that the title for the property is clean and not tied up in any legal disputes, that the taxes are paid, they handle the wire transfers to and from all involved parties. All of those services that they provide have fees or costs attached to them. You do have the right to shop title companies, but I've actually never seen a borrower do it myself. In general, title fees are relatively similar from one company to the next. And what usually happens is that the buyer's realtor suggests their preferred title company, and everybody usually accepts it. One of the reasons this happens is that mistakes with title can really jam up or even kill a deal. So if a realtor in the transaction suggests a specific company and or settlement agent, and it indicates that they've worked with them before and they're reliable. Box D is just totaling up A through C. Section E is local government fees. These numbers are what they are. The county you're buying a home in has to record the transfer of deed and record the mortgage, and they charge a fee for that. Section F is prepaids and is required by the lender in almost all cases, but you're not paying the lender. You will often pay for the first year's worth of homeowner's insurance here. This is just a way to ensure that the lender's investment is protected in a worst case scenario. Now, you'll also have to pay prepaid interest here. This part does actually go to the lender. And the number on this just depends on the interest rate and what day of the month you're closing on and the volume of the loan. If you close early in the month, you're going to pay more than if you close late in the month. Prepaid interest exists because you pay for your mortgage 1 month in arrears, meaning after you close, the first payment won't be due on the first of the next month, but the month after that. And the prepaid interest just covers the gap between closing and when your first mortgage payment is due. And then finally, at least in most cases, you have your prepaid taxes. Again, this is just protecting the lender to ensure your property tax gets paid and that the government won't have to come place a lien on or even seize the property from you. Section G is for funding your escrow account. Now, not all loans require an escrow account, but most have them. They're super helpful in my opinion. If you have an escrow account, which again just makes things easier for you, you will typically see 3 to 6 months of homeowners insurance premiums and 3 to 6 months of taxes being collected at closing here to fund that escrow account. Section H is the other section. In many cases, this is empty, but you can see things here like owner's title policies, home warranties, realtor compensation, HOA fees, and other fees the borrower will be paying for that don't fit neatly into the other boxes. Box I is just totaling up the costs from E through H. J combines the totals from D and I so you can see your total closing costs before credits, and it will also show any lender credits as I mentioned before. So you always want to take a look at section J. And one important note on J, if you see a large lender credit here, you want to ask about it. It can mean that they're offering you a higher interest rate than what you qualify for. There are some cases where this makes a lot of sense, specifically if you don't have a ton of cash to close the loan and you don't have seller concessions, but it's always worth keeping an eye on and asking about it. So that's basically all you really need to know when comparing one loan offer to another. You definitely want to do it using a loan estimate, not a fee sheet, not emails, not quotes, or anything else like that. Now, I do definitely recommend taking a look at the calculating cash to close section at the bottom of page 2. At a high level, you want to take a look at this just to make sure there's no discrepancies between it and everything that you reviewed already. But also, you want to look at the estimated cash to close number, not necessarily as a part of comparing one lender's offer to another, because there's a lot of fluff from boxes D through J that can make this number nothing more than a solid guess, but because a lot of people get caught off guard by how much money they actually need to close the loan. I've done another video on this, but a lot of people think that they just need their down payment, but closing a loan often requires a lot more money than that, especially if you don't have any seller concessions. So, just to recap, when you're comparing loan estimates from different lenders, here are the main things to keep an eye on. 1, the interest rates. This is basic, but at the top of page 1, you'll see the rate each lender is offering and whether it's fixed, and importantly, whether it's locked. Number 2 is the loan type. You just want to make sure that if you're comparing one loan estimate to another, it's actually for the same type of loan. Number 3, whether there are points being paid for that interest rate. You'll find this on page 2 in box A, and it will usually say percent of loan amount, parentheses, points. This tells you if you're having to come out of pocket to buy that rate they're quoting you. Number 4, large lender credits in box J. Lender credits can be great, but if you're getting a lot of money from the lender, it's most likely because they're offering a higher interest rate than what you qualify for. Not always a bad thing, but worth keeping an eye on. Number 5 is no fees in section A. If box A on page 2 shows 0 or little origination fees or just a small underwriting fee, ask some questions. The originator is likely making their commission off of offering you a higher rate than you qualify for. Again, not necessarily a bad thing, but something you should understand and something that should be part of the discussion with your loan originator. Number 6 is discount points you didn't discuss. If you see anything in box A on page 2 that says discount points, buy down charges, percentage-based charges, or something similar, ask questions, especially if you didn't talk about buying points with your loan originator. Sometimes this is just how the LE documents a lender paid compensation structure, but it can mean they're just planning on straight up charging you $5,000 as an example to buy a better interest rate. Again, not necessarily bad, but if they are charging you points, you want to always ask them how much it's lowering the interest rate and what the break-even period is. Number 7, dramatically different cash to close numbers. Now, cash to close isn't the best way to compare one loan to another, but it is worth looking at when comparing loan estimates. If you see a large discrepancy from one LE to another, I definitely ask about it. It could help lead you to some material differences that you may have otherwise overlooked. Whenever you're shopping for a mortgage, don't just ask for the interest rate. That only gives you a piece of the picture, and it's not a big enough piece to do a real comparison with. Instead, ask for a loan estimate from every lender that you're considering. Put them side by side, compare the same sections, compare the fees, compare the loan terms. Now you're actually comparing loans instead of comparing a sales pitch or marketing gimmicks that may not actually stay with you all the way to the closing table. If you're shopping for a mortgage and you're not sure how to compare the loan estimates you've received, you can send them to me. I'd be happy to take a look at them. I'll walk through them line by line and help you understand exactly what's different between them and what it means for you. Because the cheapest loan isn't always the one with the lowest interest rate, and the most expensive loan isn't always the one with the highest rate. The key is understanding what you're actually looking at. So feel free to use the link in the description below to book a call with me, and I'll teach you how to read the loan estimate in real time. Until then, take care and good luck with your hunt for the best deal.